Market with our special guest, Linda Dissel. And before I get into introducing Linda, I want to let everybody know that was expecting Steve Chiveron. Unfortunately, Steve had a family emergency and it was preventing him from being here today, but we want to really thank Linda for stepping up and wish Steve and his family the best of wishes from the Fnba family. Quickly, my name is Morgan F. I'm the new Senior Vice President and Wealth Management Director here at First National. I lead a team of 8 wonderful employees in our Wealth Management Department, and we offer a wide range of wealth management services to our customers, including investment accounts, trusts, retirement planning, will and estate planning, and much, much more. And I encourage you to reach out to us to talk about what we can do for you. My background, I'll give very brief. I'm a 2-year Alaskan, but I've been an Alaskan at heart all my life. While I just moved up here, I'm the 4th generation of work here. Previous to Fnba, I had a 20-year plus career in high finance, managing multi-billion-dollar portfolios, fixed income equities, multi-strat. And I don't know what took me so long to get up to Alaska and meet this wonderful team at Fnba. Before we get started, there are a few logistics that we have to go through. We will take live questions during this webinar. I encourage you to use the Q&A option at the bottom of your screen to submit your questions to our guest presenter or myself. We will do our best to answer during the webinar, but if we do not get to your question, we will make sure to follow up with you afterwards. An important disclosure before we get started. Securities recommended or acquired in any fiduciary account administered by the Wealth Management Department of First National Bank Alaska are not FDIC insured and may involve investment risk, including possible loss of capital. Before I introduce our guest, I want to touch on some news that will undoubtedly impact Linda's presentation today and some of the comments. In last week, the FDIC stepped in to protect depositors of 2 large U.S. banks. The actions in the Federal Reserve's creation of the Bank Term Funding Program will certainly impact the banking industry in the coming months and years. We are following this situation closely, and I wanted to touch briefly on what safeguards and what differentiates First National from the issues that caused Silicon Valley and Signature Bank to fail. The reasons are relatively straightforward. Our assets are not tied to the same volatile endeavors as those banks, such as crypto, the tech industry, or venture capital funding. Instead, our assets come from a diverse mix of entities across Alaska, including individuals, businesses, state and local governments, municipalities, school districts, and nonprofits. Also, First National is well capitalized with a strong liquidity position, additional liquidity options not available to those institutions. We have succeeded for more than 100 years by banking Alaskans and Alaska businesses, investing in long-term relationships and not the idea of the day. And let me remind you this, Fnba has been successful in serving Alaska and Alaskans over the last over 100 years, which includes 15 recessions, 1 Great Depression, and 1 great financial crisis. And this is not the first time we've gone through an inflationary environment. Over this same last 100 years, this bank has seen 20 periods of inflation where CPI has grown greater than 5% year over year. So I encourage you to reach out to our team or myself if you'd like additional information or if you have any concerns about your investment. We currently offer several investment strategies, including several lower risk treasury bond investment strategies that are designed to take advantage of the current yield landscape. Treasuries are debt obligations issued backed by the full faith and credit of the United States government that provide a fixed rate of return over a fixed time horizon and are considered to have low credit or default risk. As we will discuss today, 2022 and 2023 reflect an investment landscape that is correcting to more balanced levels, which signifies opportunities for long-term investments. With that said, I would like to welcome Linda Dissel. Linda is Senior Vice President and Senior Equity Strategist with Federated Hermes. Federated Hermes is a wonderful partner with First National Bank of Alaska and its wealth management division, and has provided fixed income options and money market funds for many years. Linda's had more than 35 years of investment experience as senior equity analyst. She is responsible for building and articulating the strategy, process, positioning, performance of Federated Hermes equity portfolios. You may have heard or read her analysis on national news outlets such as Wall Street Journal, CNBC, Fox News, USA Today, and more. We really appreciate her time on very short notice and appreciate her stepping in Steve's place. And I want to welcome you. Linda, you want to give me a couple of thoughts on your background, and we'll kick it off. We'll make this webinar super dynamic, fun, and interesting.
Thank you, Morgan. Thank you so much, you and everybody from First National Bank of Alaska, for the chance to talk to the group this day. I visited Alaska probably 4 or 5 times now, and it's just the most gloriously beautiful state in our union. It's just a pleasure to be with the group today. And I first want to say it's really an interesting introduction that you gave. It tells us a bit about the kind of interesting times in which we live and the importance that there is to having a long background. I've been in this business for now well over 40 years, and I see the depth of your own background and of your own bank's background, and having gone through all these historical cycles, it just reminds me that, I've met so many what we call my fellow American investor over these last months and years, going through COVID and the great scare we had then, and then the big rush back up into record highs in the stock market. Oh my gosh, it's the end of the world. Oh my gosh, I can do this all by myself. It's easy. And obviously that it's not easy. And it's very, very wonderful that everybody on the group has dialed in today, because you realize that, and you realize that the sort of situation we have, which is we live in a great country, the greatest one still of all. If we have to suffer a volatility, if we have to suffer a recession, I'm so glad to be a fellow American and to live in this country, and actually with this stock market. But also it's very important to remember, we plan to live a long life. We want our money to outlast us. And we really do need our advisors now, probably more than you ever did in your life. So I congratulate everyone for being on today, and I'm happy to talk about whatever you may wish this day, and for the group as well in Q&A.
Well said, Linda. And I really do think that that's a great way to kind of kick off what we wanted to focus on today. Again, we want to make this valuable, we want to make this informative, and we want to make this dynamic and fun. So let's really start off and, kind of with the softball question, and I kid, but, for the last 10 years, the equity market's done phenomenal prior to 2022. It just seemed like, if you invested in equities, it was always supposed to go up. What has happened in the last 18 months in the space?
Well, we really rocked the boat in these last 2 years. This is not the way a stock market historically does work. It's not the way it's really supposed to work. Basically, the stock market moves in conjunction with the earnings of corporate America. Mostly you should be bullish on stocks because mostly we're in a growing economy. Mostly corporate earnings are growing. And if you look back over many decades, an 8% return for the stock market in a given year was a pretty good result. And when the boat really gets rocked, then we see some unusual things occur. COVID was, knock on wood, a once in a 100-year event where the whole wide world closed down and really forced ourselves into a depression. Fortunately, it lasted only a very short period of time. And a lot of that had to do with record stimulus all around the world, from central banks in terms of easy monetary policy and reducing interest rates to zero, or we kept ours at zero, and fiscal policy, money being sent, checks being sent to people to tide us over while we were all shut down in our homes, if you recall. So as a result, we had a very strong economic recovery, what we call a V-shaped recovery, very sharp and fast, very sharp returns in the stock market, and still lots of stimulus money out there. One thing I know about when money is easy, and we are historically easy or have been, it always makes its way to financial markets. This time, financial markets of all countries, of all ilk, stocks, bonds, US, international, large, small, cryptocurrencies, real estate, art, you name it.
Yeah.
Found its way up. It's been a very unusual time, and that's not meant to last either.
No, a perfect point on how it affected all asset classes, right? And the power of inflation in not just those asset classes, but the power of inflation, what's going on with the equity market. I would think that most clients have heard or have at least experienced that equities have acted as a quasi hedge in an inflation market. And I want to make sure we don't misinterpret the word hedge as mitigates the downside completely. So why does an inflationary rising rate environment hit equities? We know why it hits bonds and the fixed income market because of that, directly correlated relationship. But why equity so bad?
Well, inflation at first is something that the stock market likes. Why do you get inflation? Because your economy is doing really well. Lots of people are working. Anybody who wants to work can work. Lots of people getting raises. And we Americans, we like to go shopping. We like to go out there and shop. And boy, did we have a field day on shopping, first with big ticket items that we hadn't done for really 15 years. Lots of people wanting to buy homes and just buying everything. And if I want to buy something that you're buying and the store sees that, they'll raise the price. And then we'll go back and ask our boss for a raise. And they'll give us the raise too. And this is what happens. This is how you get sometimes a wage price spiral like we had back in the 1970s. As long as companies can raise their prices, and they are able to pay higher costs of their employees and all the costs that are associated with it. And mostly in the front end of an economic recovery, and as things get better and better, then we will continue to pay up and inflation will continue to go up. And when inflation goes up, our central bank has to kick in. We have a Federal Reserve. They have two jobs with monetary policy. One is to keep monetary policy such that as many people in our country want to work as or can work as want to. And we're fully employed right now. So that's been a big success. The second is to keep monetary policy not too loose and not too tight so we can have just the right amount of inflation so that we don't have an inflationary price spiral, which is what they've been fighting in recent times here, just these last couple of years, as inflation's got out of control. This is where all that stimulus money, of which there still is a lot in the system that needs to be worked out, ends up in a problematic inflation. And we haven't had inflation like this for 40 years. I am old enough to remember the 70s when we had double-digit inflation year after year after year. And I was getting wage hikes of double-digit, just not enough to meet that amount. So the central bank's job is then we have to raise rates. We have to make it more expensive for you to borrow to buy a home, to borrow to buy anything, for businesses to borrow to buy. Make it more expensive so that we get more prudent. Maybe they have to lay off some people so that we can't keep asking for raises. This is a normal cycle, but we've not been in a cycle with this much inflation for 40 years. So it's a bigger fight this time than it has been in past decades.
I'm glad to hear you refer to it as a normal cycle because, we've gotten used to, as a market, to experiencing year over year phenomenal returns in the equity market. And, there's some complacency that sometimes sets in and just, that's going to happen year over year. But now we're starting to see with the rates and what the Fed is doing, the yield component return, right? And where not only yield, but and the bad side of this is the capital costs are increasing for companies. And before I get into the value of yield, from an equity standpoint and from a fixed income standpoint, one of the concerns that I'd like to talk about is with companies, their cost of capital. If they go out to reissue debt, they go out to reissue equity, it's at a higher rate now, especially on the debt side. How do you feel about corporate balance sheets today? And do you feel like they're in a position like we saw in the 2008, 2009 financial crisis?
Oh, that's an excellent concern to have because, the price of debt, interest expense, is one of the bigger expenses on most companies' balance sheets. And interest rates have been going up here really quickly in this last year. And they may or may not be done raising rates now, but it's really expensive if you wanted to borrow. And that could be disconcerting, except for the fact that corporate balance sheets today, again, another reason why I'm glad to be an American consumer, an American who lives in this economy and who invests in this stock market, because the vast majority of companies out there, their balance sheets are in not just good, but really spectacular shape in order to deal with whatever economic recession we have. Why is that? Because if you remember when the housing bubble burst all the way back in 2007 and 2008, it rocked a lot of people. We had a terrible bear market then. We had a terrible recession then. And the economic recovery starting in 2009 and for the next 10 years was really kind of modest by historical standards. Consumers didn't believe it, businesses didn't believe it, and they hoarded cash. They've had a big pile of cash on their balance sheets. Now interest rates have been extremely, extremely low. And many companies, especially the larger ones, said to each other, you know what? We don't need to borrow, but interest rates are at generational lows. You saw companies, the likes of Disney, for example, McDonald's, for example, borrowing out 50, maybe 100 years to get low interest rates. They have a big pile of cash on their balance sheets. Their interest rates are fixed at lower interest rates, and they are not concerned with rising interest rates. What a great environment if you had to make your way through the environment that we're in for strong balance sheets. Yeah. That's something that is really wonderful this time around.
Well, that's good to hear from you because, as we transition our conversation into, yield and focusing on yield in the asset classes, on a portfolio construction standpoint, that is one thing that we're looking at on both the equity and fixed income side. We're seeing spreads or yields widen on corporate debt, which is, it feels bad right now, but it's really a good thing long-term for investors because now we've got not only a current income stream, but we've got a yield that is actually tangible, that actually offers a real rate of return, right? And then on the other side, we've got equities whose strong balance sheets, the valuation of these companies have contracted. But again, you're looking at a great environment from a balance sheet perspective. One of the things we're looking at, that we continue to focus on is equities, but from a yield perspective, what are your thoughts around dividend yields and companies that have been, very consistent and persistent with maintaining or increasing their dividend rate, and that type of allocation within the equity markets?
Well, yes, yield is extremely important now. I mentioned I'm a baby boomer. There's a lot of baby boomers out there. It's where the vast majority of the investable money is. And, we get more conservative as we get older. We plan to live a long time. We're supposed to get more conservative in a defensive way. And that always meant buying treasury bonds of the United States. But interest rates have been so low for the last 15 years that you really couldn't get paid for yield. And that's why a lot of people thought there's only one place to go. I need to buy stocks. And I tell you something, Morgan, I've been in this business a long time, the last almost probably 18 years. The most common question by far and away that I have received from advisors like your team, yourself and people like your team is, where do I get income for my clients? So when treasury bond yields were exceedingly low for so long, the dividend strategy, and that is, I want to underline the high quality dividend strategy, was a very excellent place to go on the equity side. It used to be for decades that dividends represented at least 50% of total returns. That hadn't been the case in these last basically 2 years, 20 years, when it was all about growth stocks, tech stocks, momentum, et cetera, that didn't bother with dividends. Now, the dividend strategy is back in vogue, but it always was a place to find some reasonably safe income. Companies whose management say, my culture is, when we make $1 of earnings, we pay a decent percent of that out to our shareholders as income. And that now more than ever is being looked at as the bond market has had some tough times here, particularly last year, and is still a volatile area. Very important area for always, but particularly now.
Sure. Well, Linda, we're coming up on 20 past the hour, and I want to ask you one more question, and then I want to open it up for questions. But with where equities are, with where fixed income is, with the overall macro theme that you feel very confident about, as far as corporate balance sheets, where do you see equities continuing to play for clients as an investment strategy, generally?
Yeah. Well, we think that it's important that we always knew that one of the first important jobs for any investor is to diversify your portfolio. And I think we've seen in these last number of years, we can run from one area of the market to the other, stocks, bonds, US international sectors, and make a lot of money or lose some money. Nobody can read the future. That is the most important thing. It's a very interesting time now in our country's history where we have an inflationary problem that is being fought. We do have value that is starting to show up. And I think you brought up one of the very best areas, which is fairly defensive dividend stocks. But there are a lot of areas where if we're long-term investors, I will emphasize long-term investors, can find pockets of value where stocks, areas of the market are particularly cheap. It's a great environment to look for stocks of high quality, lots of ability to generate cash flow, strong balance sheets. And that's what we do. That's what we do in our business. And that's what you and your advisors do in your business, is find those stocks, bonds, US and international. They're everywhere in a diversified manner. And it's just more important to do your homework now. Sharpen your pencil and do your homework. And remember, your advisor is near at hand.
That's what I was going to say. A little selfish and shameless self-promotion. Work with your wonderful wealth management team here at Fnba to put together an asset allocation strategy to meet those long-term goals, right?
Absolutely right. It's more important now than it ever has been. And no matter what may happen in terms of markets being volatile, not only is the balance sheet of corporate America strong, consumer balance sheets are quite strong. We're fully employed. This is a great country and will remain a great country. So, so always remember, I think, we have rough patches, the long-term investor is in a great place here in the USA.
And Linda, wonderful insights. What I want to do now is open it up to questions. If anyone has a question, I believe, please put it into the chat. And if you don't have a question today, but you want to circle back up with myself, or anybody on the wealth management team, we're always available to answer anything that you might want to talk about. So we'll give it a few minutes for anybody to throw a question or a statement within the chat, and we'll address them as they come in. Don't be shy. Well, we might be shy today. We might have a shy group today, Linda. That's okay.
That's okay.
There's a lot going on in the market, and I know it's a lot to digest. So we'll give it a few minutes here. Well, while we do that, Linda, you were talking earlier about coming up to Alaska and your trips here. You've been to all 50 states, is that correct?
Yes, I have been.
That's
in
amazing.
my travels, I travel pretty much every week on behalf of our company, and I have been. And Alaska was my very last one. I insisted on going on vacation, and such a wonderfully beautiful state. My daughter actually worked there for a few summers, so it's a great place to be. And actually, while we wait, and I do hope to get a question or two, or even a comment or two, I do want to say to you, Morgan, and to the group that I have had the opportunity to travel all around the country and talk to groups like yourselves for 40 plus years. And what I've come to learn is that the investor group has become much more students of the market, much more well-schooled than ever before. So I know that questions will come up always, and as long as you feel comfortable with your advisor, I'll bet you that your advisors over there at First National Bank will take any calls, and whenever you have, there is no question that is not worthy to be answered.
Yeah, you are not wrong, and we are here to help. So we do have one question, and I think it's the topic on everyone's mind is, and it's related to credit. The news out today on Credit Suisse about their financial backers not going to step up, but I think it relates to the overall issue or concern about possible contagion risk, from the systemic failures of some of these banks.
Yes.
You have any comments that you want to talk about that?
Yes, I'll be pleased to. But now I don't cover Credit Suisse itself. Of course, it's very disconcerting because, as you mentioned in your opening comments, Morgan, the trouble that we've seen over the weekend was really very much focused on just certain high risk pockets of the marketplace, and even in the state of California, you don't have that many companies that were as at risk as was the one that went into receivership over the weekend. The regional banks have become much more concerned because of that, and most regional banks are in really excellent, spectacular shape. Most big banks are too. Credit Suisse is a big bank that has a lot of great people in it, a lot of great research actually too that we tap onto, and they've been one of the lesser banks, in the lineup for some time. Their stock has suffered for some time. It's the thing about the market is, when the market starts to go down hard, people worry if it's going to be systemic, and that is always especially emphasized when it's in the financial sector. It's appropriate for it to be so, but it's also important to not panic and say, oh my gosh, you need to sell everything because Credit Suisse is now having a problem. We don't know. Nobody knows how long this is going to last, how deep it will do. But what we do know is that banks, the vast majority of banks, are far more better shape than they were back in the 2002, 7, and 8 crisis. So I really believe that this will settle down. But as a stock market investor, I wouldn't be betting hard on any particular scenario. We're suggesting humility and patience.
Yeah, it's definitely going to drive some headline risk for a while, right?
It will.
The entire market. So, we got a question from the general audience, and it's what do you think interest rates are going to do, and do you think they're going to continue to go up, and how do you think that will affect the stock market?
Okay, what will interest rates do now? You have long-term interest rates and you have short-term interest rates.
That's right.
And long-term interest rates is the stock market betting on, is there an inflation problem, or are we worried about recession? And right now, the long-term interest rates are worried about a recession. But the Federal Reserve is the one that's watching the actual inflation situation and fighting the good fight. And they have been raising rates fairly dramatically. So a quicker increase last year than you had ever seen, although from 0% interest rates, which we had no business being at for as many years as what we did. So widely believed, as we at Federated Hermes believe, that they are at or near the end of, even if you didn't have these flare-ups, these crises happening, at or near the end of their rate hike situation, and maybe very much now will be on hold because the inflation fight is going to take a little bit of a backseat right now to making sure that financial stability risk is for sure settled down. Excellent possibility that once settled down, we may continue to have an inflationary problem. They may need to raise rates a bit more, but for sure may need to keep them higher for longer. As a saver, you'll like that. As an investor in stocks, it's a higher expense in general. It argues for not double-digit returns year after year like we have been seeing, but more mid-single-digit and a bit better if it's a decent market. We'll be pleased if that's the result. Right.
No, great answer. So we do have another question, and we'll continue to remind everyone, if you have a question, please put it in the chat. We want to make sure we address everyone. So, the age-old question, is the market underpriced, overpriced, fairly priced? And maybe historically, if there's some anecdotal data that you could throw at us as to, where has the S&P, kind of resided whenever it's, kind of in a normal environment. I know normal is a constantly changing description of the living environment we're in, but, how do you address that when you have clients asking, where is the valuation at with equities?
Okay, and of course, this is an art and not a science. And that I'm sorry, but that's the way it has to be, because we bid the stock market as an investor group on what we think the next 12 months of earnings will be. And obviously, no one knows that for sure. If we go into a tough recession, which we are not calling for at Federated Hermes, it's different. If we're right and this economy is really quite strong still, then we probably won't. And so the pullback in the stock market that took us down to S&P 500, about a 3,600 level, 700 level in October, was a good low number that, as long as we don't have a terrible recession, if we touch that again on a test, which we should do on a volatility, That should be the bottom of it. And then we can look forward to getting back up over 4,000 S&P, maybe towards 4,300 S&P. That is simply based on what we think earnings will be and what price we should pay for them. As long as inflation is too high, we won't pay as much for every dollar of earning. But if we believe that inflation is coming down, which we believe it is doing, then we can pay a bit more and a bit more. And if our scenario is right, not a bad recession, a mild one, we're going to get out of this and presumably not before too long, with earnings growing back up again next year, then you could argue that the stock market today is reasonable, maybe a touch expensive, maybe needs to test lows again for some nervousness here, but not nearly as overvalued as what it was, at the beginning of last year, not nearly as overvalued. And that has to do with a lot of the price action coming down on tech stocks, which were severely overvalued. So, and if I may, and I don't know when we're going to get cut off here, but last year we had a 25% decline in the S&P 500. That's people worrying about the next 12 months. That was a lot of progress on getting valuations back towards a more normal level. And that's something important to remember. We've got a lot of the damages behind us already. We can have volatility, but we may be not overpriced or too much anyway. And it is not an screaming sale at all. I can't say that at the moment. We're not on a big sale right now.
Sure.
No.
Quickly, and I know we're out of time, but I want to make sure that we get at least to these last two, or we can always take them offline. One, someone's asking where they can get more information on First National's, financials and banks. Our financials are published online. You can find them on our website. And I don't know who asked that question, but if they would like to set up a call to discuss the financial and diversification of the actual bank, would love to do that. And then also, what about the 31 trillion US debt that is unsustainable? That is, and quickly, that is what we're feeling today, is the inflation that is existing, to create a more sustainability around that. The good news, bad news is that the Fed definitely wants to see some inflation, and feel free if you have a different opinion, Linda, but in this environment, they're able to inflate their balance sheet away. Asset value goes up, debt, while it's growing, but debt doesn't grow with inflation. So this is an environment where you'll be able to see some of their debt actually inflate away based on the underlying environment. We obviously want to see them curtailing, the level of spending, because that will ultimately compress, future rate decisions and the ability for us to, maintain go forward inflation. But Linda, last comments, anything on that before we wrap it up?
Yes, and just ever so briefly, and I agree with everything that you said there, Morgan, and I think what we're going to be watching is the value of the United States dollar. That's the rest of the world chiming in to say, is our debt too high? Are we getting well ahead of ourselves here? And so far, we are a strong US dollar, but it is important to safeguard that and not to think that we can keep going on and on. And so we maybe get some of our fiscal house back in order here.
Well, great.
Would
Well,
really
Linda,
help.
you've been incredibly gracious with your time. I so want to thank you for bringing your knowledge, your expertise, and your commentary to our webinar today. I look forward to doing this many, many more times, maybe one time in person up here. But then I also want to make sure everybody online knows that if you've got any questions that we didn't answer, you want to follow up with any questions that you did have, please reach out to me or someone within the wealth management team, and we will get on the phone and set up a call or an in-person meeting to go over any questions, concerns, or ideas that you might have. But Linda, again, thank you very much. And I want to thank the entire First National Bank Alaska team for putting this together. And we will see everyone at the next webinar Wednesday event.
Thank you.